Dipen Sheth, Head Institutional Research at HDFC Securities, joins us now. Dipen, good morning. Thank you very much for joining us. How do you, what's the advice now for people who are entering to buy at this stage? Is there gains to be made in 2015? Should it be bought in the Nifty? Should it be bought outside the Nifty?
So sure, there are gains to be made. I mean, I think the cycle which was triggered by the arrival and election of this new government, it's gathering pace. I think we are in a superb, what should I say, illusionment cycle, if you will allow me to coin a word, after 3-4 years of disillusionment. And there's a confluence of many positives here. Yes, the big reset has happened. I mean, for the new year, we did release a model portfolio update which started by saying that, the big reset is in, and now what happens. But, look at, it looks like nothing can go wrong. There are so many positives. We've got a new business-friendly right-of-center government. Oil prices are down. So, Achhe Din and Lucky Din have both come in together. Inflation is cracked. Interest rates are on the way down. The rest of the world is struggling. In fact, there are crises in many other parts of the world. And the two largest democracies and the first and the third largest economies by purchasing power parity are the only ones which are steadily and strongly growing. So what have you, the Krugmans, the Rogoffs and the Talibs of the world are all constructive on India, and so are FII fund managers without exception. So I think there is money to be made here. The government is delivering. We've seen the first few flushes of reform. Notwithstanding the stalls in Parliament, I guess more will come. We've seen some very good action on coal. We've seen some action on freeing up investments in railways and insurance, opening up mining, rest of the mining also. I think today they are going to allocate some 36 blocks to PSU units. There's reform coming up on GST, a little bit on labour.
So what is it? Are we looking
I can't see anything wrong here.
Are we looking at 9,500? What are we looking at?
Let's not put numbers. I'm saying it's all right, so what's the tail risk? Okay. And that, I think, is something people are not looking at right now. I don't want to be the party pooper here.
Just hold on for a second, Dipen. The CBI has actually arrested Dayanidhi Maran's additional private secretary, so he's commenting on that. Let's cut across.
Give false statements to indict me. So in this, I'm also planning to write to the CBI director. And in fact, when I was called, the irony of this, these three personnel were called more than 10 times by CBI in the last 18 months. They have been called to Delhi several times. They have gone and they have cooperated absolutely with the CBI and also in Chennai they have cooperated. It's not that they have been called for the very first time. But if CBI is going to act like a state government, like a state government machinery, I also wonder what is forcing CBI. Is CBI trying to please some RSS personnel who is trying to get benefit that because he exposed and he wants to get the credit? It is a sad phase for CBI, and I am ready to pay. I also cooperated with them, and I find no reason if there is an offence against me.
All right, that's his anger against the CBI and fears that the personal secretary may be forced to give statements against him. Sonia.
Yes, in fact, Dipen, I wanted to ask you about what one should do in terms of investing into large caps or mid caps, because in your report I read, you say that for the broader market a further re-rating is unlikely. So do you reckon that it will be more profitable to invest in large caps in 2015?
So let me recant a little bit of that. What might happen is that I can take a rational view that a reset has happened and a big re-rating is unlikely. But if the world and its investors continue to find India to be very attractive, especially in a relative way, with respect to the rest of the world, whatever's happening in Europe or other emerging markets, apart from India and in the rest of Europe, let's say, the big money and the fact that, Europe and Japan are not anytime going to stop their internal QE programs and money is going to get printed. The US is going to keep getting better as an economy, which means end markets for key exporting sectors from India, such as software and pharma, will continue to be strong. So who am I to oppose this momentum? The money will keep gushing in and the whole Nifty might go through. I think the kind of dramatic reset that happened in the days around the election and following it may not happen so quickly, but yes, a continuous upward drift for the Nifty is not ruled out so long as the money comes in, and this is what is getting dicey. I'm relying on money flows to justify the markets going up. I'm not making any huge balance sheet analysis or something and telling you that valuations are in an attractive zone. Already you have the first few numbers this quarter which have come out, and analysts are saying, don't look at these numbers. 16 is okay, but 17 and 18 and in some cases 19, excuse me. So I think we are running the risk of getting a little complacent here. There is this, overarching tendency that the tide is turned, and it's going to go even further, so invest first and then investigate. It will actually make money for a while. That's the funny part. It's counterintuitive to, kind of believe in it and say so, but it will make money for a while. But when the tide goes out, you will be kind of exposed in slightly more than embarrassing.
So you can't argue against money, and
you can't argue against the momentum. So yes, the Nifty may well drift up and drift up faster than what I would like to see it, but it doesn't listen to me.
Dipen, I was going through your note, and you've written that you look to add ITC should the upcoming budget spring a nasty excise hike. So you wouldn't be disappointed with what the numbers have thrown up, and you would look at every opportunity to buy into the FMCG stocks like ITC?
Overall on FMCG, things are beginning to look very, very costly, and they've been costly for a while. They've got very costly, and now they've got very, very costly. ITC, on the other hand, is trading at much lower 30-odd% discount to the average industry multiple today. There are good reasons for that. One, you saw about a 60-70% excise hike in the last budget that the government presented, and you can see the results of that excise hike in the 12-13%, 11-12 kind of percent lower cigarette volumes. That's also an imputed number. The company is not very clear about, it's not very transparent about numbers on that part, but these are imputed numbers, and despite the 10-11% kind or 12% hike or thereabouts that they took, so revenues were a little higher, and then they've got fabulous pricing power, so you still had that 8-9% EBIT growth in cigarettes. I think the greatness of ITC is the ability to swing back after the initial shock of lower volumes comes in. This has been historically true. The debate is, will this continue indefinitely into the future as taxes go up? So you saw that 70% tax hike last time around, and then a couple of quite a few governments, whether it was Tamil Nadu, Assam, Kerala, I don't remember which ones, which also had VAT hikes. So again, this entire burden of indirect taxation, is it now getting too much for a great company to bear, is the question being asked. From an investor's perspective, should cigarettes be taxed? Of course they should be taxed. I'm not against that. The good news here is that it's still not ad valorem. I think that would be a structural no should that come in. We are still on a fixed specific or a fixed duty structure. I do believe that this government, strapped as it is for cash, will probably try to milk the ITC a little more, and I think that should provide a very meaningful bottom. And this quarter's volume decline, let's hope that volumes come back over a period of time. History suggests so.
Okay. I want to ask you about financials. I mean, we just saw L&T Finance announcing good numbers. You heard Mr. Devasali speak. There is a rate cycle. What are you buying in financials, if any? Is that a bulk of the portfolio?
Of course. So financials are today anyway more than a quarter of the index, close to about 30-odd%. Even otherwise in the broader market, you have an interesting range of a variety of financial services models which are being run by very capable businesses. So right from the apparent bottom of the chain in terms of market cap rankings, such as let's say microfinance, you have some great companies that are listed and unlisted. I'm expecting to kind of now see Bandhan grow into a bank and get listed and command fancy valuations at some point of time. They've got a huge inflow commitment signed on recently. Then you're seeing a fabulous recovery from a complete collapse at SKS Micro, and God knows that they've got their act in place despite all the troubles that they've been through. You've got very good capable mid-tier private banks like a Federal Bank or a DCB steadily inching up the quality curve and doing it so beautifully that my word, they look cheap at 1.5 times or thereabouts. You've got the private sector banks, one or two of them I'm constrained not to talk about, or the larger NBFCs, but you look at an Axis or an ICICI, and despite some of the alleged asset quality overhangs, they've done magnificently in terms of granularity of lending, in terms of retail franchise, in terms of maintaining their spreads. And you have the housing finance companies who are now going to face or going to run into fatter spreads as the interest rate cycle comes down. PSU banks will book treasury gains as interest rates fall. I mean, what can go wrong for financials from here? It's all getting, everything and everybody in financials is going to do well. I'm sorry to disappoint you by not giving you a segregated view, but it all looks fine to me.
Okay, one final question then. In your auto exposure, you say that the best gains have already been made at Maruti. So for someone who owns Maruti and has made money in it, has the time come to churn? And if yes, into which
So we did churn, Sonia. We did exit Maruti, and I was in a little bit of a half and half there. It's a fabulous story, and I can't find a better proxy for discretionary consumption in this country over the next 2 or 3 years. The question to ask is whether it's all priced in or not. It's not that I have anything against Maruti. So to that extent, what we did was that we exited Maruti in our model, and we added a lesser known company such as SML Isuzu, which is a far more cyclical industry and trucks and buses, and is very, very capital efficient. If you look at the size of capital invested in the company versus what they're capable of delivering, they're still into single-digit market share right now. And but the quality of their product, the cost structures that they have, and I see, so a little bit of an uptick in volumes, which will come to them naturally with the tide, and plus a few other things that they are doing on their own. And I would expect that very strong operating leverage will play out. So for me, that's an alpha idea. It's not that I have something against Maruti. So if I have to outperform the Nifty, then I have to get out of Maruti and get into something which might give me higher returns. And that was the guiding principle why we chose SML Isuzu for the model.
256% higher, you will buy it over the year.
Oh yes, we are not concerned about what has happened in the past. We are looking at what will happen in the future. So that's fine by us.
All right, Dipen. Pleasure speaking with you on macros and micros. Thank you very much for joining us.
Thanks, Lata.
Thoughts.